So you're a racing guy?
Yeah, I grew up in like in Bombay, India, right? There were no racing cars, there was nothing. So I just got these road and track magazines and whatnot, and I never even imagined that I'd be in one, right? And then somehow, after falling off the mathematics bandwagon, I got into Wall Street, and suddenly, yeah, there I was. I could now afford a race car and things like that. So I actually started doing these very, very technical driving things called autocrosses. That's in like very technical around traffic cones and whatnot. It's timed events. It's not really wheel to wheel racing. It's sort of like
Mhm.
time to, and it was totally addicting. So I just got totally into it. And believe it or not, I'm an old guy. I was an old guy then. So you need to be a young guy to do that sort of stuff. So, true to form, my sons started to race and they actually started racing go-karts. So one of them is actually now competitive and spec me out of racing nationally. So, it carries on. So yeah, I have a love of that sport, but it's very much like risk management, right? It's like, you want to have a good time, you want to stay alive. That's just like trading. It's just like the markets.
Yeah.
That's awesome. That's
You
really
need to.
cool.
Any favorite cars that you've driven or courses that you've raced on?
You know, honestly, everything is fun, but the Porsches, the GT cars are pretty amazing. Like the GT3s, the GT4s, those are pretty fantastic. Though I must say that the lower end Mazdas and all that have come out, they're sort of your poor man's Porsche, and they're just as much fun. And believe it or not, when there's a technical course, you can take out like one of these MX-5 Miatas, and they can actually beat a Porsche GT4 or something, as long as there are enough corners and not too many straightaways. So it's really fun.
Yeah,
Yeah,
it's amazing.
very cool. Well, talk to us a little bit about your background, Adil. Where'd you start your career, and take us to where you're at today, Samara.
Yeah, so briefly, because it's been a long career. It's I started in mathematics and really ended up on JP Morgan's mortgage trading desk in the early 90s. And for a math person, clearly derivatives was the way to go. So we started doing these synthetic mortgage swaps and arb trades based on swaps versus cash bonds and all that. So that was my start of all this sort of derivative area. I ran like various books over about a decade. The last stint was at Barclays Capital, running their swaps and mortgage derivatives book and off balance sheet arb book. And then got an itch to start a hedge fund. So I started a hedge fund, ran that for a bunch of years, and being the naive young person I was, I had no idea that a hedge fund is more than just making money. You have to have marketing, you have to have business, you have to have accounting, you have all these other departments that I'd never heard of, right? Because I was a Wall Street trader. And so, yeah, we made good returns, but we never built a business. And so that was my intro to hedge funds. And then I joined Protege Partners, which was a hedge fund kind of seeder and small and emerging manager specialist. And they were just 50 million at the time. At the peak, we were over 4 billion, and our seed managers were managing over 12 billion. So that went on for a couple of decades. So really invested in hundreds of different hedge funds, got involved in all the seeding aspects of it, negotiating contracts, making sure that everyone was just slightly unhappy so that the seeder and the manager would stay in the game at least. Because there's so many times the managers did really, really well and they would just retire. That's no good.
Yeah, that's tough go.
Right? You want them to stick around, so when the revenue share kicks in, you actually make some money. So that was a very good stint. But in 2015, believe it or not, the partners of Protege, we ended up putting some money into the digital currency initiative out of MIT's Media Lab, and that time the Media Lab there was run by Joey Ito, and he and other people there were very much in love with Bitcoin and the technology, but they did not, think that it was going to survive because it was right after Mount Gox. It was after everybody was talking about just the Silk Road and how it was only for criminals and what. I mean, they haven't stopped talking about that yet, especially in certain areas of Congress. But at least now it has more subs. It's better off now than it was then. So anyway, the digital currency initiative started. We put in some money. We got introduced to some early founders in the space, and so the actual first kind of big hedge fund was Polychain, right? So Olaf we met before we started the fund. Richard Craig of Numerai. We ended up being day $1, some GP stakes. All of that worked out really well. wasn't really a hedge fund. It was just like, speculating on a wildly effervescent market, which was great. And then, Protege unfortunately shut down in 2019 because the founder passed away. And, damned if I was going to do long short equity and credit anymore. I just said that digital assets is the way to go. So since then, I did some friends and family investing through SPV, some ARB trades, and then joined up with my friend Wilfred Day. And Wilfred actually was at the same credit derivatives desk in the late 90s at Barclays Capital with me, a year after me. And so, we have derivative background. He ran a crypto broker dealer called Enigma Securities out of Macor. He ended up, we did some trades together between my SPVs and his firms. So I knew him quite well. We said we have to do an asset management company. And so we started Samara Alpha Management. We had a little bit of a bumpy start at Securitized Capital when Styler, I met you. They didn't really want to have too much crypto on the balance sheet. And since we were a crypto asset manager, that didn't fit too well. So we went off on our own. Got really funded by, at that point, what was called Cryptology, which is a German public company run really by Christian Angermeyer. And so he's a Bitcoin bull, very, very creative person. And we were super lucky to get funded in the depths of the bear market.
Well, that's exciting, Adil. Yeah, he's just obviously coming from the bear market. Obviously, that's an interesting story, right? It's been tough for everybody there. I'm just curious from your point of view today. People talk about kind of current state, institutionalization of the market. What's your feeling, given your kind of where you've been and where you are now?
I think the institutionalization is just beginning, of course. I mean, look, a whole asset class that's only a couple $1 trillion cannot be institutional. I mean, when we were talking to people like CalPERS and CalSTRS, I mean, their normal ticket size is like billion plus. You can be running a $20 million hedge fund and expect CalPERS to
Right.
allocate to you. So at this time, what I see is really the similar state of affairs that hedge funds were, I would say, in the early 90s, right? Where, at that point, hedge funds had been invented and they were around, but, the really interesting strategies like convertible arbitrage and merger arbitrage and all of those things, options arbitrage, they really started in the 1990s. And it was easy pickings because nobody was doing them. People didn't understand them. So you could basically throw darts and make a lot of money. And that's kind of where we are with crypto now. The ARB strategies, the sort of professional trading strategies, the pros are just coming into the space. And then 2017, 2018, you could look at two screens and buy Bitcoin at one price and sell at the other. That's not possible. You need to have a lot more automation, a lot more systems. I mean, we have people who have teams of dozens of engineers just, doing all the operations, the APIs and all of that stuff. So it's become like a professional thing. And the pickings are still very, very good because you can take very simple ideas from TradFi, like equity stat arb and spread trading in fixed income derivatives, apply it to crypto, and with a lot less leverage, you can make a lot more money because the volatility is higher, the dispersion between coins are higher. There's a lot more volume now than there was 4 or 5 years ago. So really, it's kind of a very good time right now. But I would liken it to the time when operationally hedge funds were dangerous, and so operationally crypto hedge funds are still kind of dangerous. You don't quite know what's going on. There's new custodial solutions coming on and all that, but therefore the returns are high. I mean, look, the average return for hedge funds in crypto space last year was like 60 or 70%. There's some older hedge funds that have been around for 5 years, annualizing at 60, 70%. We had market neutral market making funds last year that were making 100% gross last year in a dull year, right? And come on, in equities and bonds, those numbers are not possible anymore. So it's almost like rinse and repeat in the crypto market. What happened in the kind of crazy hedge fund world in the 90s and in the early 2000s. And then by the mid 2000s, 2015, it was dead in traditional hedge funds. Fund of funds were all gone. That there was fee pressure. I mean, I knew we had some competitors at Protege Partners that were charging 20 basis points for active management across a bunch of strategies. That's ridiculous. That's like ETF fees, and you can't. That's really boring. So now crypto hedge funds are still at the moment very, very interesting. So we're quite excited about it. And seeding is a totally different game in this world. I
Yeah.
mean, the average ticket for a seed was like $50 million that we used to do, right? Here you can seed somebody with a couple million because that's all they need. right? I mean, if you're making 50, 60% returns, you don't need that large of an asset base to actually make a living. And of course, the capacity of the markets is constrained anyway. So it's kind of downsized for like the principals, high net worth individuals, and the like. And the institutions will come later. These same individuals who are the principals of larger institutions will get their institutions into the space, but after a while. I think
Yeah,
day one is like high net worth and family offices. That's where we're at.
sure. That's an interesting point. Obviously, smaller ticket sizes. And you mentioned another thing about just technology and just operations and things. Obviously, you said when you first started your fund, you learned a lot about that process early on with your hedge fund. Now, current state today in digital assets, there's new systems and tools and technology, exchanges, custodians, all these things happening. Is that getting better in your view? Just
Much better.
yeah,
Oh, hugely better. Even, I mean, it's been slowly getting better, but then the last year, particularly after FTX, it just like rushed everyone into like, we got to solve this problem. So there's a lot more off exchange settlement solutions. There's a lot more tri-party, almost like a way to have your assets secure, but have credit to various different parties. So your assets in your margin is not at the actual exchanges and brokers. Your margin sits at a custodian. Only the amount that needs to be at the exchange is at the exchange. So it's gotten a lot better even in the last 6 months. And I would say that more solutions coming down the pike all the time. So I think that in 2017, 18, it was way more dangerous. But in the end, it is still at a space where counterparty risks are going to be here for a long time. And so the only way around that is, diversification. I mean, you just don't want to have all your eggs in one basket. So whether you go to different jurisdictions from a regulatory standpoint, or you go to different exchanges from a exchange counterparty standpoint, or if you go to different protocols with respect to any DeFi that you're doing, don't do everything on like Aave and Compound. Go out there and do some different stuff. So that diversification, I think, is the key to survival in the space. I mean, a lot of sort of more diversified pools of capital in crypto, when FTX happened, I would say the diversified average fund of funds or pool of investment down about, I would say, like 8 to 12% was the number. And we were invested at the time. That was about the number. And you can afford a 10% drawdown if you're annualizing at 30-40% a year, but you can't afford a 40% drawdown. And so if you shouldn't have like 80% of your assets at FTX, you should never have had that. On the other hand, it was tempting for some people because their funding rates were good, their liquidity was good. I mean, they're subsidizing a lot of trading. So, I could see like how someone might get tempted, especially since they were such a blue chip name. And now everyone can, Monday morning quarterback is always like, it's easy, right? It's easy. It's easy to say XYZ and it was obvious and this, that, and the other. And of course, the people who say the loudest are the ones who happen not to be on it. Right? Maybe on a Tuesday they would have been on it. I don't know.
yeah, 100%.
I survived that, you know, learn some lessons, but diversification is really the way to go in a new market with new coins, with new protocols, with new risks. I mean, these are all software programs. They have bugs. They're gonna keep having bugs forever, you know?
Yeah.
So, yeah.
Yeah, I guess as we continue to, evolve, hopefully less and less bugs along the way.
Yeah, but
Talk to
but
us
you
about
keep inventing new things, right? I mean, even Bitcoin. Remember, it was supposed to be
yeah,
ossified and never change, and suddenly, with ordinals, now they're building L2s on Bitcoin,
Yeah,
and there's suddenly going to be this and that,
it's a
and
whole other
people
DeFi.
are
world.
just like all over the place, which I think is fantastic because I mean, you want fees, you want it to survive, you want it to be useful, but its narrative keeps changing. Payment system, not only a store of wealth because it's not used for anything. Now it'll be used for everything again. Then what is it? A payment system again, or an L2 on Bitcoin? I mean,
Yeah, the innovation is
yeah,
staggering. Yeah, it's exciting. I think. Yeah.
yeah.
Yeah, no, really, really cool stuff to see. Talk to us about seeding funds. So, what type of funds do you guys seed? What are some of the things that you look at when you're seeding these different funds and talking to these asset managers?
So the biggest sort of the overarching thing is to have like a really good investment product, right? So whatever strategy, whatever we do should fit a niche very, very well. So it doesn't have to be market neutral, right? It could just have a very good Sharp ratio. It could have some beta to it. It could be whatever. But if it has beta, it better be better than Bitcoin, right? So that's actually an incredibly high bar. Like you have a lot of people, and they say they were up 120% last year. That kind of sucks, Like, I mean,
Yeah, you might have
everything has to be
underperformed versus
yeah,
Bitcoin.
yeah. Everything has to be compared to what it's trying to do. And if you want beta, and you have this liquid, easily tradable thing, and it's up 120%, you better be up more, or you better be down consistently a lot less, consistently, and that's just not easily had. So there's so many funds that have Bitcoin as the index, and the hedge funds, and it's the usual thing. Well, we don't lose as much, we won't make as much, and in the end, after a while, you just realize that this is the old game of just collecting fees. So the investor makes less, you get the fees, they haven't made any more than what you were promising them. So it's a tough thing if you have beta to actually beat some very simple indices in a market that's just going up. And that was really our impetus for doing the Bitcoin denominated thing, because our treasury is Bitcoin. So we start with Bitcoin. We will get Bitcoin returns, and anything we do on top of it in a market neutral way will be additive. The treasury can make 1 or 2% a month Bitcoin on Bitcoin, but they're actively traded, whatever, whatever. But if you're always going back to Bitcoin, like I'll to give an example, market making. Market making is very lucrative in this kind of fragmented market, right? You can buy coins at one exchange, sell them at another exchange, different geographies, usually the same coin, different prices. You just have to get the money from one place to the other, which is not trivial. And you have to make sure that nothing fails and the API still works. I mean, it's a lot of work, but you can buy one thing and sell the same thing at two different prices all day long, which is a great way of making money if you can do all the rest of it. But in that way, you have to post margin at the exchange. You don't have to post dollars. You can post Bitcoin. If you post Bitcoin as your collateral and you're making markets, you just every time you make markets and make P&L, convert it back to Bitcoin. Now you have something that will always beat Bitcoin because you have Bitcoin. If Bitcoin goes up and down, your margin is going to go up and down. And whatever P&L make, as long as you don't buy high and sell low on your coins, which hopefully your algo knows not to do, it's like a money making machine. Of course, you lose money every time an exchange goes under. So then all that diversification, risk
Yeah,
management, everything comes into play. But you can have then a strategy that by construction is going to beat Bitcoin return, but not by you being particularly smart on timing. Because, after whatever, 30 years of investing in active managers, nobody can beat the market in timing. And everybody starts out thinking they can do that. And and then they shade it this way and that way and whatever. They only remember the good trades. And in the end of the road, unless you have some clear information advantage or algorithmic advantage or processing advantage, like the HFT guys, you are not going to be able to call the market. There's just too many people playing it. So just forget about that. So that's the kind of, you don't see somebody who comes to the door and says, I know when this thing goes up and down. Okay, fine.
they
You
probably
you
don't.
go do that. If you you go do that, unless they can systematically show that they can do that with many, many, many trades, and that's only possible if it's automated, if it's processing some kind of information from either natural language processing over the net or some kind of on-chain data that's faster than anybody else can get it, and combine it together in a way that the rest of the market cannot just easily see on the screen or retail can't see on the screen. Then you might have a way of sort of timing the market to a little bit. So I mean, a very long-winded way is that we've seen anything, but it has to be comparatively better than Bitcoin. Whether if it's market neutral, then yeah, it has a chance. If it has beta, then it has a chance. If there's some real information advantage, or if it's a sector fund of some sort or whatever. The other thing I'd say is that, seeding, it's really a business of raising assets and also having a good product. And you cannot, as one entity like us, Samara Alpha Management, we're not going to seed two, you know, DeFi funds that are doing about the same thing, or two funds that are doing perps and financing, because then you're competing against yourself, right? So I mean, we want to find like few best of breed managers, or whom we think are best of breed and capable, and put them in business, and then that's a roll of the dice. I mean, most hedge funds fail. You know, we at Protege, we seeded, while I was there, about 45 different hedge funds around the world in every single strategy. Every time we put one in business, we were like, this is going to be the best thing since sliced bread. They're the best. And then, some of them went off the rails in a month. Like, they didn't even
Wow.
wait. It's incredible. Things just go south. You don't know. And the difference in seeding hedge funds, if you do it right with the risk management, is that when they fail, you take your money out. Like, you don't put it like a venture thing where the money goes into some bank account and you don't see results for months or even years, and then you might get it back or you might get 100 times your money back. You just don't know. Here, it's all liquid stuff.
Yeah.
We have full rails around it. We
Mm-hmm.
always put investment guidelines, stop losses, whatever, so that at some level, if it's not working, we go our own way. We get the capital back. We get to seed someone else. Live to fight another day.
Right.
That's the whole key. So it's unlike venture in that you're not going to get 100x on your money, but it's also like you're not going to lose 100% of your money either. And the
Yeah.
way you get multiples on your money is really that you seed it with small amounts, right? So we can seed managers with a couple $1 million. If there is $100 million, now you're getting rev share on the 100 million. That's where you get the multiples. So your little investment can become like 10, 20, 30x, like venture like returns. But it's not because the thing became more valuable. You're just getting fees on everyone else's money as well. So
Yeah.
that construct, if you can monetize, it's a very good construct. And the way to monetize is you have to do more than one. So
Yeah.
we've just seeded our first fund. If you just stop there, it's like a total roll of the dice. I mean, I think these guys are the best things since sliced bread, as I said. They are, in fact,
Yeah.
fantastic. And we're going to be out there, and I would put all my money with them right now. But day after tomorrow, I don't know.
Yeah.
We'll find out. So we need like 10 of them, right?
It sounds like the type of funds you guys are looking for is particularly like quant trading funds, or algorithmic trading funds. And with the, it sounds like you're getting a part of the GP as well. And then do you
Mhm.
guys, do you encourage the funds to take a Bitcoin denomination as part of that
if
process?
they're excited about it, sure. Like, I think we would love everyone, all the funds, to have a dollar class and a Bitcoin class as well. I think there's going to be, if all goes well, more and more Bitcoin wealth out there. There's a reason why they want to keep it in Bitcoin, and there's a reason why they want to do something with it. And I've talked to a lot of Bitcoin maximalists who would not ever invest in a Bitcoin denominated anything, because if it's not in their hardware wallet, they're like, that's the end of the world. And those are fine. That's fine. That's that, more power to them. I would still encourage them to give like 10% or so into like a more trading oriented thing. Because look, you put 100 Bitcoin in your ledger, 20 years from now, you have 100 Bitcoin, which is great. But take 10 of it and put it into something that's making 10, 12% a year. And in 20 years, you could have twice the number amount of Bitcoin, right? Or maybe the 10 will disappear and you say, oh my God, what did I do? But I mean, you still have the 90, right? So that's, again, this idea that, you shouldn't put all your eggs in one basket, even if it's Bitcoin,
Yeah.
right? So there you go.
Yeah. That's interesting. Yeah. And that's some great points there. Obviously, diversification across your book, right? That's key. Not just stopping with your initial fund manager investment. You mentioned in the Bitcoin denominated share classes. I've seen others obviously gone down the road of Ethereum, ETH denominated. Have you thought about that as well? What's your thoughts regarding other?
So the reason why we didn't do ETH denominated up till now, and I see a little bit of a headwind to that, is
Right.
that there's a lot of competition for ETH returns. There's a lot of ways to get returns if you have ETH. So the bar is high. Like, you get 12% ETH on ETH returns. It's kind of like, whatever. I could do like bazillion different things to get that.
Right.
Bitcoin, you get 12% Bitcoin and Bitcoin. That's like, wow, that's out of this world. And since there are strategies you can do that can get that without betting the ranch or without like risking your capital,
Yeah.
I think it fits very well, right? Is that the return hurdle is not high enough for you to have to take too much risk, and yet it's beneficial to the people who own Bitcoin, who are just really not doing anything. They don't really want to lend it out per se. Lending becomes like one of those picking pennies in front of a steamroller. I mean, it can be done well. I know people. I mean, Bear Stearns, for example, they lent money to hedge funds for 20 years and didn't lose a dime ever, right? They just, like, because they did it right. You lend against liquid collateral, and if things go south, you liquidate.
Hmm.
Unlike Genesis Trading or any of these others who
Right.
Right,
lent money
Celsius.
unsecured and still didn't call the capital.
The Wild West. Yeah.
So I would say lending can be a good business, but it's not necessarily what a Bitcoin hodler wants to do. Um, so I do think though that the other the other denominated, I know another fund that's the DeFi fund that I think they have some really weird coin denominations because they work for those treasuries, which is fantastic. You have one of these protocol treasuries and you allow them to make returns on their own treasury assets. Those are all creative ways of raising assets in this crypto world. And depending on the coin, ETH is probably a commodity, maybe, but Bitcoin is definitely a commodity, right? So the Bitcoin, the IRS has ruled, is property. I mean, there are many cases now that it's considered property. You have to pay capital gains, what have you. And that's a bit of a pain if you want to buy coffee, right? But it is not a pain if you have a fund that's denominated in Bitcoin. Because, if you're contributing property to an investment fund that also has property, it's like this like for like exchange. So at that point, it's not necessarily a taxable event when you contribute. So like you could have bought Bitcoin at $50 and you now put it in a fund when it's at 60,000. If it was a dollar denominated fund, you'd effectively be selling your Bitcoin at 60,000, paying the capital gains, and then that's it. And then you get your dollar invested in the fund. But if the fund is denominated in Bitcoin, your Bitcoin is the currency of the fund in a way. So you're contributing Bitcoin to that partnership as an in-kind contribution. And so there's an advantage, right? So you can then, get your returns in the fund that's in Bitcoin. And then in the end, when you redeem, you get Bitcoin back. So again, it's a property exchange. It's not like a taxable. So of course you pay taxes on the money you made, but your thing, which was Bitcoin, you gave it, came back. There's no tax. It's almost like a, loan or something at that point, right? So it's interesting what you can do using regulations and tax law and all that to the way that they were intended to be used, rather than wanting it to be something else. Like buying coffee is like, okay, I can't buy coffee with that. Not
Yeah.
yet.
Yeah. That will it creates some efficiencies too, right? So if someone's investing using Bitcoin into your fund, it's a Bitcoin denominated fund. The settlement process, the reconciliation process
Yeah,
is
we don't have a bank account.
right.
Guess what? We actually don't have a bank account.
Yeah.
We just have wallets. And, that's a big difference now versus 2017, 18, right? There wouldn't be an administrator back then that could easily treat everything properly and do financials in Bitcoin easily so that the auditor could audit it easily. And now there are a bunch of auditors that we work with that are top 10 auditors that are happy to deal with all of that stuff. The tax people, way to make the record, because the IRS does not recognize Bitcoin income. Every time you have anything, they translate to dollars, and so you have to be very careful about the timing and what prices were used, and so that the unrealized and the realized cancel each other out, so you don't have tax burdens that usually. These are all like above my pay grade, but I know that they worry about it a lot. But they are there, and they're trained to do it now.
Yeah. Yeah.
They're,
Well, AML
trained to
KYC
do
is
it.
there. You're just creating a more efficient framework to get in and out of the fund, to create
Yeah,
distributions, all those things, right?
yeah, yeah. Yeah, and I mean, look, for a brief instant in this whole market, we thought that we'd just get around the whole KYC, AML, and money laundering and all that stuff. But I think that is there for a reason. It's fine not to launder money. It's fine to make it very difficult for people to do any kind of illicit activity. Those are all fine things, and I think most crypto people are absolutely fine with those regulations and restrictions, and they're figuring out how to deal with them, even at the DeFi protocol level. Right? They're finding out ways to sort of incorporate certain kind of non-call lists or what have you into their protocols. It's just that's where we have to go because nobody wants to finance that stuff anyway. So
Yeah, well, I mean, I would say too, it's creating a better solution for the the old antiquated process of operations. Settlement. A couple of business days, T plus three, whatever it is, plus one. This process is now being appended, which I think is a good thing, and to a better technological state of how you can operate a fund and how you can do things quicker, faster. And now, to your point, you can have a couple $1 million and put it to use based on
yeah,
what you can invest in, and it's have a good rails around what you're doing and compliance and all those things and move quickly and more efficiently.
Yeah, and I do think that eventually, in the not too distant future, like a couple of decades, um, we will have most of the financial rails be on some kind of cryptocurrency backbone rather than, and blockchain backbone rather than Swift and banking and all of this stuff. Because I mean, it is better. So people are starting to move towards it. I think a large thing is like this chicken and egg. Like investors have to be comfortable with it too. So tokenized funds, tokenized, all of this will come, but everybody has to be comfortable with it. It's not easy for people to trust these things until they see it being used a lot. And in order for this stuff to be used a lot, the user interface has to be better. The whole seed phrase thing has to become better. It's just a lot of things have to be good, but they're already good. Like we have certain custodians where it's totally like it would be hard pressed for me to see how they could lose the crypto. I mean, it cannot move until they get people on video, different people in different places doing different things, and then finally the coins move. I mean, it's way more secure than a paper check signature.
Yeah, control process,
you know,
whitelisting of wallets, all the whole framework they have in the back end. Yeah,
yeah, and for the admins too, the admins don't even have to wait for the fund to report the trades. They just have the wallet APIs, the read-only APIs, and they can see what's happening pretty much real time with the hedge funds. So hedge fund admins have become very, very good in the crypto space. Financials and all that are coming out very, very quickly. Every now and then something gums up, right? I mean, like I
it
think
happens. Yeah,
like some of the new technology last year for um, custody, where people were doing this third party type of custody, where you had these wall garden type stuff, off exchange settlement of various sorts. And so off exchange settlement means that you have to like now change coins from here to there when they actually don't move, but they're, and it just made all kinds of crazy stuff. And so everything was gummed up, but now it's clearing up. Like now it's clearing up.
yeah,
The
Yeah.
backlog is clearing up.
In
definitely.
terms of hedge funds, and how have you seen the crypto hedge funds change, going back to, let's say, 2017 till today?
Oh, the
What are some of
biggest
the
thing,
things
yeah.
that, yeah,
Yeah.
that have stood out to you?
Yeah, the biggest is the types of people involved, right? I mean, back then, like the TradFi people weren't really into crypto. They couldn't be. Actually, it's funny. One team that I know very well, they were at a TradFi stat arb shop back in 2017, 16, 17, and they had a day job making good money at a French bank. And they had this thing running at night and 24/7, this algo running on crypto, making a lot of money. We wanted to seed them out of Protege Partners. We said, this is great. Leave. We'll seed you, blah, blah. This is like, why? We're making a day job. The thing is trading all day long. We're like,
Right.
right? Um, but those guys actually ended up starting a fund. I invested with them. They're fantastic. They're one of our best, stat arb type people. But that was a rarity. Most of the people those days trading crypto were people who just learned of it. They didn't weren't from finance at all. They were from technologists, whatever, and they said, wow, this thing moves a lot, you can buy and sell it. Very retail oriented, very much screen oriented. They didn't know risk management, money management. They didn't know the business of investment management. They didn't understand fiduciary duty. Like if there was any talk of not trading the same coins that you were investing for your investors, it was just like, wow, how does that make any sense, right? So he's completely clueless, right? And that is like quite different now, and that's the biggest change. Like you can find lots of hedge funds that have top auditors, have good controls over internal trading, front running, all of the stuff that you should have, which is obvious that you should have if you're trading. You shouldn't be trading in front of your customers. It's just not what you should be doing in any way, shape, or form. But those types of people have come. Like the best funds we have are people who came from some HFT fund in equities, or startup fund in equities, or market making fund, where they were used to doing order book analysis for the very fast paced equity markets globally, and now they're starting to do the same thing for crypto, different exchanges. Again, it's more of an operational hassle. The algorithms and the actual ideas from TradFi carry over really, really well right off the bat. And then there are ones that you start adding on chain data, and the on chain data compared to 2017 to now. It's a lot more available. There's a lot more you can get, and still people don't use it that much. Believe it or not, people still think that most of it can be done by price and volume. And yes, it can, but then that's just a momentum trade, which is fine. We know momentum works in every single asset class, but there's a lot more information that you can put into crypto trading that if you do, you get an edge, right? It's hard to do, but you can
Yeah.
definitely do
What
it.
what are some of the things on chain that you look at?
I mean, the funds look at mostly the wallet movements, sort of like the speed of wallet movements, how much is on exchange, how much of it is, uh, directly on chain versus exchange by exchange going up. Exchange owned wallets are tracked a lot more from FTX, and any movements are actually tracked on Twitter because everybody's looking for the next FTX. There's not going to be a next FTX. The next blow up will be completely different. That's what's things. I hear people always want to close the barn door after the horse is gone. FTX was the horse; it's gone. And then the next is not going to be just huge centralized counterparty. It's probably going to be some DeFi problem. Is my guess, right? It's going to be something like that. Some restaked ETH or something like that is gonna, you know that the leverage is, and it'll all blow up, and then they'll say, "Oh my God, how could this happen?" Well, it could happen because you restaked it 17,000 times, and now a 1% move blew you up. I mean, like that's what's gonna happen, right? So the difference now, again, sorry to your question, is that the quality of people is very very high. Back then, the quality was high in terms of intelligence, knowledge of the protocols, kind of, you know, crypto natives, fantastic people, just not very well versed in money management, investment management, fiduciary responsibilities, all of that stuff. These days, it's a lot of the latter. Like they already know what's going on, whatever. They're teaming up with some of the crypto natives and all of that. And so that makes a really good mix. Like that makes a really good mix. And so we're excited to actually seed some of those guys as well. I mean, our seeding business is just getting going. First seed was from this lark of a contest we had at Bitcoin Miami and Bitcoin Amsterdam. We're going to do another one in Memphis, I think, where we announce something, we get a lot of competitors, people vying for it. And honestly, we had some really great people. I would say all our three finalists I would have put money with. But there's only one winner. So we'll do that. And now it's come full circle where some of our investments in funds, they've been around for a few years now, and they're spawning off. Their star traders, their star people are leaving to want to start their own thing. And that's how we got a lot of our seed managers at Protege too. Like, you have a very good established fund. At some point, the star people of that outgrow the structure because now it's huge. It's not as entrepreneurial, whatever. And the fund itself, is often supportive of them leaving because they know, like, this is they know when they started their fund, right? And so we
So
already
that
got incomings from existing investments in funds, people calling us, listen, XYZ wants to leave. We're thinking of putting some money on them. Would you guys do the dirty work of setting it up and figuring out how to pitch it and all of that stuff? And so, yeah, that's exciting now. So that we're getting that second generation coming out of crypto hedge funds already. Crypto just works faster. Like, everything is happening faster. Cycles, hedge funds. Hopefully, AUM growth will become faster too, because it's been actually very difficult
Yeah.
for some of these people. I mean, the Star fund that I talked about in 2017 that have been at it since then, and at a shop independently, whatever, they're still managing under 50 million, right? And annualizing at whatever, 40, 50% with the 20 vol. I mean, that's numbers that regular hedge fund investors would die for, but except when they have crypto on it, they're just kind of like just barely nudging in, just barely crawling in. But I think it will change. It will change. And then for us, it's, as with everything, when there's a lot of capital, opportunities are very small, and when there's no capital, opportunities are very big. So seeding is a very cyclical thing. Right now is a great time to find smaller strategies that have been around. They survived the bear market. That means they figured something out and it's still working. They've been stress tested, and they have no capital because nobody wanted to invest for the last 3 years or 2.5 years. They're all ready to go. So if you have capital and you have a way for them to go, it's a very good time to seed. fast forward 12 months from now, if this bull market keeps going, and then like, people will start throwing money at really silly things, and then at that point you
Same
should
thing
see
all over
nobody.
again.
Yeah, don't seed
Yeah,
anybody.
Yeah.
Because everything that would possibly need you as a seed and give up any equity is something that doesn't quite work, right?
Yeah,
It's
as they
like
say, when the
negative
Uber driver,
selection.
yeah, when the Uber driver's the expert, tell you to invest, it's probably a
yeah.
problem.
With the seeding business, so obviously you give them capital. Talk to us about some of the other things that you do to help these funds and
I mean, the
maybe
capital
like
is
risk
actually the
management, different
least.
things.
Yeah, the
Hmm.
capital is the least for crypto hedge funds in particular, because what they need is more of a, first of all, just the structure. If you have onshore and offshore money, Cayman structures cost money, legal fees are off the charts, compliance is off the charts. Auditors won't even audit you if you're a startup fund and you have a couple million. No auditor is going to take you on. They're too busy, whatever. So they get all of that, right? You get like a fund, you get an auditor, you get admin, you have legal, you have marketing help, you have help with sort of making sure that you're coming up with a strategy that is attractive to investors. Because remember, we have all of us either have no hair or gray hair, or lots of cuts and nicks, and so we kind of know the different investor pockets. What high net worths would want, what kind of risk reward they'd want. What are the available strategies. Like if someone comes up with like 100% return with the 80 ball, we just say like, we can't do that. No one's going to invest. Like it's just not in a hedge fund. You could get that in a straight crypto spec thing. So how do we make it into something that actually is marketable over a cycle and all of that stuff, right? Um, so yeah, everything else other than capital. Capital is probably the least of what's beneficial to them, because if it's good, you get a year track record, then you can get capital. But you need your track record in a structure that everybody believes, that's audited, that people can trust, and they think that it could be easily scaled up without a lot of changes, right? Because if it needs a lot of changes, then it won't work. And there's it's funny, like there's strategies. You really have to understand the strategies to figure them out. I mean, there are anomalies in the market that work in small size, even in large cap stocks that wouldn't work at large stock. I mean, I know people who came to me with like a strategy based on only S&P 500 stocks and claimed it was very, very scalable. But the thing they had recognized was there was some weird anomaly that happened to certain stocks at the close because of ETF flows or whatever. And if you want to do more than $1 million, it wouldn't work, right? But because they're large cap stocks, it doesn't mean you can do $1 billion in it. Patterns exist because in the micro place in the market, there's some ebbs and flows, some supply and demand that's more than that particular venue or that particular instance can support. And it might just be 5 minutes before a close of a particular ETF that have some foreign stocks and US stocks. And yeah, you can find that it's a real arbitrage or opportunity, but it exists for small dollars, and that's not reasonable. So you have to understand that too. And again, as far as the types of strategies we seed, we do our best to try and figure that out, that this is not making money for some like trivial reason that's just it's just going to go away, you know so
Yeah, that's interesting. I mean, it sounds like there's a lot of things you can help as you have conversations with potential firms that you're going to work with. Obviously, you just mentioned the seating is just one component, but even just the advisory, just what's demand in the market look like. You're basically creating your another business, right? Operation,
yeah,
sales, all these things are
yeah,
important, and it's seating is only one minor component. It's important, but it's the entire ecosystem that need to have buttoned up to really
yeah,
drive the business.
yeah. And I mean, the other, I would say that one part we didn't touch on is that the time in the market right now is very nice because it's small. Like you can actually get your hands around pretty much all the hedge funds around there, almost, right? Like pretty much you can get all the startups. It's small enough. It's not thousands, it's in the dozens, right? And you can know what they're up to, and the investors themselves, we know each other, like the other people who are concentrating on market neutral investing. I know them. We swap ideas, because for all of us, it behooves us to build these smaller managers up and make sure that they exist, because I want these returns for quite a bit longer. And if they don't raise assets, and I don't have infinite assets to give them. I need other people to invest with them as well. So at the moment, it's like find the good guys, advertise them, get more money into it, build the whole space so that it's bigger. And yeah, of course, we compete a little bit, like, oh, I did better than you last month or whatever. But I mean, in the end, we want these funds to grow. We're not hiding them from each other, right?
Right.
We trade ideas, we do reference calls for each other, and they're a great bunch of investors in the crypto space at the moment.
Yeah, well, going back to what you originally said, which diversification, you're diversifying your book of business, going along the other side
Mm-hmm.
of other investors as well, and kind of helping each other out.
Yeah,
Yeah.
yeah.
Anything you're excited about in the market currently?
I mean, the main thing is the crazy bull market is back, which is fantastic, and I'm particularly excited about the whole Bitcoin functionality space. Personally, I was quite worried about just this whole thing of in 10 years, 20 years, if no one's using Bitcoin for anything, it didn't seem like viable to me. And suddenly there's a renaissance of the old the oldest cryptocurrency being useful again, not just for meme coins and NFTs, but also people are building real layer twos on them. I think the amount of development that's happening on Bitcoin is fantastic. I've seen a couple of funds now just dedicated Bitcoin startup VCs and things like that. So that is very, very good, because I so that's probably my thing I'm most excited about in the next year, is to watch the Bitcoin ecosystem start to flourish, as much as the madness of ETH, right? I mean, ETH will always have a place. I don't at all prescribe to the one coin world or the one protocol world. I think there's lots of space for quite a few different protocols and coins. I think Bitcoin and ETH will definitely be around, but Bitcoin will now probably be around much more. I have much higher confidence that it will, because it is not only around, but it's being used more and more. So I mean, there was a time there where the mempool was huge. It was making more fees than Ethereum, I think, for a couple of days. That was really fun to watch. So it was like the tortoise and the hare thing, right? Like the
Yeah,
tortoise finally caught up, and he's like, "All right, here we go. I have better security now. I'm bigger, and now I can do some of the things you can do." So
yeah. We were
that was
talking to
fun.
one of the miners recently. He said that the fees, go back like 6 months, kind of before the ordinals were about 1% of their revenue. Today it's about 15%, or
Yeah,
when we spoke to him a couple weeks back. But
yeah,
really, really cool to see the Bitcoin market develop like it is.
yeah. And now with the halving, it's not such a big deal. So they'll get fewer coins, but they're getting a lot of fees, and they'll probably get more fees, and more people are building on it. So yeah, it's that's probably my most exciting thing. Um, you know,
What are your thoughts on market outlook? Maybe macro, or just kind of in general. What are you seeing out there? What do you kind of think? In a near, or couple years future.
well, I think from a lens of like Bitcoin, one of the more interesting things that has happened over the past 2 years is the kind of move away from the dollar in global commodity markets, right? So, I mean, the euro dollar, or the sort of the petrodollar, was put into place like decades ago, and it was the ruling currency of all commodity trading of all sorts, right? Gold wasn't really used that much, but it was just as a store of value. And then, China, Russia, India, you know, all of them are motivated not to be stuck to the dollar, but they had no way out really. But they started getting a way out because they were forced to, because the U.S. just took all the dollars when they when they hadn't. So that was a move like, okay, this is no longer the risk-free currency of the world if they can just take it away like that. And then
Right?
that came
Sanctions.
alongside the fact that the U.S. dollar is really backed by a military and just faith, whereas even if you look at the Russian ruble, you could argue it's backed by natural gas, right? It's a commodity currency, and commodity currencies have a value that's independent of whatever is going on with the printing or what have you. And so now, I mean, believe it or not, like, you know, almost 20% of the oil last year was done in non-dollar trading. People don't even realize that. That's a lot. Before it was nothing, right? So as the currencies of the world sort of go more towards the commodity currencies, the major commodity producers will become quite powerful. I think that's a geographic fact. I don't think you can get away from it. The Chinese opened the gold exchange in their part. And so the Chinese gold exchange now globally for the people who trade with China, there is effectively, a gold price of oil. And then since there's a yuan price of gold in the gold exchange, there's suddenly a way for them to be not dependent on the dollar price of gold. Because if they were, they would eventually get squeezed out of the energy markets because China is an energy importer. So it doesn't affect the US that much because we have enough energy. But for major energy importers, if it had always stayed in dollars, they'd be beholden to the US forever, right? And the policies of the US is diverging more and more from some type of global protectionist type view to just like a, internal, let's take care of ourselves type of view. It is reality. I'm not saying good or bad either way, but I think the biggest moves I see are like in energy markets, along with the commodity complex changing from a dollar price to maybe gold price, maybe yuan price, maybe a basket price. And that'll actually become, at the moment, Bitcoin is too small for that because it's tiny compared to the types of commodities that we're talking about. But I think that's going to end up becoming very relevant in the not too distant future where, yes, the Bitcoin might become like the currency that starts to be used for commodity trading because, first of all, everyone can access it. No one can shut it off. One of the things about the non-censorship of something, like you can't shut off gold, right? I mean, a government could take it over, but you could take gold anywhere to far corners of Zimbabwe or India or some island, and people will still give you value. There's not much like that, right? Diamonds, but they're very, very, they're not that many diamonds. Bitcoin is like that. So eventually, I think it's going to start playing a role in the global trade markets. I think those are very, very early days. But I would say on a macro level, that change that started in the last 24 months to 48 months, 2 to 4 years ago, it started when China started doing this and was, motivated to do it before they got shut out. I think that's going to be, I think, the moves to look out for in the next few years.
Yeah, really cool stuff to think about.
Yeah.
Kind of wrapping up here, Adil, with any advice you'd give to somebody looking to start a fund?
Don't. It's too difficult.
It's a lot of work, right? Yeah,
It's a lot of hard work.
yeah, a lot of gray hair.
Yeah. Yeah, no, being a little facetious. I mean, look, I think the people who start a fund sort of accidentally come upon it. I think if you are thinking, oh, I want to start a fund because that's a good way to riches, it's not going to work, right? There's lots of people who are starting funds and who want to make it in this business, but the people who make it end up there because they somehow are in the right place, or they saw something and it started to work. Whether they were at an existing shop or with their family, they found something, a way of looking at things that actually worked to make money. Now you can start a fund. But as an abstract, oh, I want to start a fund, don't. It should come to you because you already know what you're doing. You figured something out. It was a hobby. It was a great hobby, and it started work really well. And you said, "Can I turn this hobby into a career?" Then you start a fund. So I think it's like abstractly, and I actually haven't seen it work abstractly at all. I mean, I would tell you a couple of times, more than a handful of times, people want to start a fund, and they say, "Okay, let me find the best trader, the best marketer, and this expert in this, expert in that. Put this team together." And there's no real fire. There's no actual thing that distinguishes them from all the other people who are doing, because there's lots of those people. There's lots of CIOs and lots of traders and lots of this. And like, what's creating something better than anything else before? It's usually somebody's unique creative or unique experience that gives them a different outlook on things. And then that starts making money. You're not going to manufacture that, right? I guess there was the turtle traders and these few people who train traders. I mean, there's for a particular type of thing you could do it, but I don't think in most markets you can do that. In most markets, if you look at the people, either they had a passion as a teenager and they did it and they failed a bazillion times, but somehow they kept doing it and it worked, right? Or they were talented and they were talented because it just came out that way. It's like sports people too. Like some people shouldn't be ballerinas. You can't decide I'm going to be a ballerina. I mean, you just can't. Like you have to have certain things in place, physically and mentally. You can't just decide to become a ballerina. I think trading and money making is similar. You can't just decide I want to do it. Few, very, very few people can. Unlikely to work that way. Yeah.
Yeah, I totally agree. It's well said. There's a lot to it, and a lot of blood, sweat, and tears, shall we say, along the
Yeah.
way.
Yeah. So I think the ones who are out there who have figured out something interesting and they came about it by accident or just through passion that was not related to, oh, I just want to make money, then come see us. We could help you out,
Yeah.
take it to the next level. But other than that, I would say, find something that you love and do it. Not that you want to do X or do Y or do Z. Yeah, first find the love. Yeah.
Yeah. Absolutely. Awesome. Well, Adil, this has been a lot of fun. Really appreciate you taking the time. Where could people go to connect with you?
So Samara Alpha Man, so samara-am.com for samara-alpha management.com. The website has all the links. Our info link is there, and all of that stuff.
Awesome. Thanks so much for the time, Adil.